Welcome, everybody. This is the Global Macroeconomic Review. My name is Matt Smith. I have the very easy job of being the host here. The star of the hour is Reid I'Anson. He is our senior economist, and he's going to bring us action, drama, tears, laughter here as he looks at the US economy and how Trump is going to affect things, the European economy, if it's still going to be moribund, and then taking a look at China as well and our expectations there. So without further ado, I'll hand it off to Reid. All yours, Reid.
Matt, thanks so much, man. Yeah, as Matt said, I'm a senior economist here at Kpler. I work on the insights team, focused on driving insights, driving forecasts for GDP, inflation, looking at Fed policy, and allowing that to flow through to our supply and demand modeling and our price forecasts. Today, we're going to be jumping into a number of key economic blocks from the US to China, European Union, India, and Japan. Kind of breaking down where I see GDP go in each of these economies and what inflation looks like, as well as examining a number of key geopolitical and economic policies. But before we get to that, we need to break down kind of where I see global growth going into 2025. I am currently forecasting a 2.7% growth rate for 2025. Note that this is structurally below growth rates we saw pre-COVID. Say in the 10 years up to and through 2019, growth rates were averaging closer to 3.1%. And again, post-COVID, I am forecasting growth levels will be structurally below this level, largely due to slower Chinese growth levels, which I'll break down a little bit later in the presentation. In terms of specific country breakdowns, if you look at India, they will lead the pack at 6.5% growth. We think the Chinese economy and Chinese policymakers in particular will target a 4.5 to 4.6% growth level. The US will continue to grow above trend at 2.5%. The euro will lag the group of major economies again, growing at 1.2%. First, let's kind of break down and into what the US looks like this year. And I kind of like to set an economic narrative, one or two words that kind of explain each of these economic blocks. And for the United States, I would say the narrative is really one of outperformance, right? If you look at growth over the last couple of years, if you look at this chart on the right, this is just headline real GDP growth. Growth over the last couple of years has been just under that 3% level. This is well above long run trend growth for the US, which is closer to 2%, right? So US growth has been strong. However, that has also come with an issue of sticky inflation to a degree. Yes, we saw some disinflationary impacts last year. However, our view is as we head into 2025, inflation is going to get sticky around this 3 to 3.5% level. That is built on top of our expectation, as I mentioned on the last slide, of growth of 2.5%. Again, still a solid 50 basis points above long run trend. So again, kind of core thesis for the US this year is continued outperformance in terms of growth, with output remaining above trend. However, inflation really getting sticky in that 3 to 3.5% level on core CPI. We think that the Fed's ability to cut rates is going to be really constrained. Probably one, maybe max two cuts through the second half of this year. And if we dive into looking at what is driving the U.S. economy, it's consumption, right? Household consumption is 70% of GDP. And I love to look at this chart on the left here, just looking at quarterly household consumption. Again, this is inflation adjusted, well above pre-pandemic trend. In Q4, we saw a 4.1% rate of growth across the consumer, really strong, continuing to hold above trend. And again, even looking at monthly real consumption expenditures up and to the right, last year alone, month over month growth was in positive territory in all but 2 months. We do think that this is going to continue, largely driven by a stabilizing labor market. If you look at non-farm payroll growth, we did see some weakness, say through the first half of 2024. You look at that unemployment rate, it also did tick higher, say, from late 2023 through the first half of 2024. However, that's kind of ended now. We've seen an uptick in payroll growth over the last 3 or 4 months. Unemployment ticked back down to 4% in January. This is towards the low end of the range, going back 6 months in time. So it is our view that the labor market has stabilized and will continue to provide support to consumption. And some of you might ask, well, why didn't we get a slowdown in consumption last year? The labor market did weaken some. Keep in mind that that weakening was off a very, very low unemployment rate, right? 3.5% is historically low for the US. And so, yes, we saw some weakening, but off a very, very low baseline. And even when looking at more real-time statistics, things like U.S. jobless claims, right, on a weekly basis, continue to hold pretty much in line with what we've seen the last couple of years on a seasonal basis. Again, indicating stabilization after some weakness through the first half of last year. In terms of our calculation of labor market balance in the U.S., again, this chart on the right, anything above zero implies a labor market shortage. Early 2022, we were short, 6 million workers, very, very large shortage, of course, that has eased considerably. But in our estimation, we still think the U.S. labor market is short somewhere between 750,000 and a million workers right now. Of course, when we're talking about labor market shortages, availability of labor supply, you have to talk about the labor force, particularly immigration. Look at the chart on the right here. This is just foreign-born labor, so immigrant labor, both legal and illegal, absolutely surged through the Biden administration, right? If you look, again, that right-hand side chart now, foreign-born labor is holding, 10 to 15% above trend, right? And, foreign-born labor since 2022, if we go back to looking at this chart on the right, about half that decline in labor shortages, we were short 6 million workers, now we're short 750,000 to a million. About half of that decrease in shortages was driven by this foreign-born labor piece, right? I bring that up to highlight the risks here of nominal wage inflation as the Trump administration largely looks to reverse what Biden did in his 4 years in office, right? Trump is not only looking to close the border and really enforce illegal border crossings, but is also pursuing a pretty aggressive pace of deportations as well. So this, in our view, could very much put pressure on the U.S. labor market again this year. We think that nominal wage growth is kind of going to get stuck at a floor of 4%, with upward pressure certainly there. And that's problematic when considering that, in our view, you really need a nominal wage growth between 3 to 3.2% to sustainably get inflation back to 2%, right? So nominal wage growth between 3 to 3.2. Of course, nominal wage growth right now kind of holding around 4, and we think that's kind of where it's going to hold as a floor this year, especially as the Trump administration pursues limits on immigration. Of course, the offset is you could see some easing in the services sector, especially around housing, as you see less demand because of a slower pace of labor force growth. But again, I think the offset of higher wages, again, kind of builds into our outlook that inflation in the United States, as a result of above trend growth, but also because of this immigration issue and wage inflation, will keep core CPI in that 3 to 3.5% range. If we just kind of dig into the inflation piece, we got CPI figures yesterday, and so the chart on the left very much is up-to-date data. Data wasn't good, right? If you look at the 6-month moving average of core CPI, that black line, we ticked back up to 3.7%. That's the highest rate we saw since Q2 of last year. Largest single month increase, which is that blue bar, since early 2023, right? So the U.S. economy right now, as we have kind of been communicating to clients over the last several months, the reinflationary threat is definitely there. And the market's been telling us this, right? If you look at 10-year yields relative to the start of a Fed cutting cycle historically, we've seen an absolute surge in 10-year yields, roughly 100 basis points of increase. This is uh, in part being driven by concerns around inflation, right? And so we've seen since the Fed started cutting in September, uncharacteristically, you tend to not see this very much. Long duration yields really pushing higher. And again, part of this is being driven by concerns about inflation. Of course, some other issues are it's just being driven by expectations of pretty strong US growth, concerns about the Trump administration, a number of factors. But one of these keys is concerns about inflation. Deficit spending also playing a role in the inflation problems in the United States, albeit this is also helping to stimulate US growth. If you look at the chart on the left, this is deficit spending as a percentage of nominal GDP. Typically, US nominal GDP is anywhere between 4 and 6%. Historically, when we're in those levels, deficit spending is 3 to 3.5% of GDP. The last couple of years, we've been closer to 6.5% of GDP in terms of deficit spending. So way above what we tend to see historically when the US is growing at a relatively normal rate. This has been stimulative, right? You've had the Inflation Reduction Act, the CHIPS Act, the infrastructure bill. You had the large spending package in 2021, right? All of these are helping to stimulate US growth. But also this pushes up on the deficit and creates inflationary problems as well. There is also this pretty brutal feedback loop. If you look at this chart on the right, the Fed is forced to raise interest rates because of heavy deficit spending, which causes inflation. That the increase in interest rates also pushes up on U.S. Interest payments, right? U.S. interest payments now are exceeding $1 trillion a year. That's more than the entirety of the U.S. budget for defense, which is roughly 800 billion, right? So the cost now to service all of this debt comes at a very high cost. So it's stimulative deficit spending for sure, but it is also inflationary. We think that this is going to continue. We think that during the Trump administration, deficit spending is going to remain in a range between 5.5 to 6.5% of nominal GDP. Yes, you do have efforts on the behalf of the Department of Government Efficiency, but they probably won't cut any more than, say, 200 billion per year. That's 3% of the federal budget, right? At the same time, Trump is committed to not reforming or cutting Medicare or Medicaid, which alone is 45% of the U.S. federal budget, right? So until you start to really focus on entitlements and defense spending as well, I think that we'll continue to see pretty elevated amounts of deficit spending in the United States. Just shifting to tariffs to kind of close out our conversation about the U.S. economy. I'm kind of, for now, of course, this is all very much in flux and things can change day to day, but I'm coming with several scenarios. So if you look at those first two bullets here, these first two bullets basically make the assumption if the U.S. undergoes aggressive, broad-based import tariffs on our major trade partners, from Canada to Mexico to Europe to China to a lot of others. Under that scenario, you basically have two potential outcomes. One is prices rise in the United States, but over time, you have some degree of manufacturing reshoring that helps to limit the drag on consumption. As a result, U.S. growth holds at or above trend, albeit inflation kind of gets stuck at 4% on core CPI. The second outcome is that prices rise again, but we do not get that manufacturing reshoring really happening. This exacerbates the drag on consumption. U.S. growth falls below trend, say to a range between 1.5%. But that does allow inflation to ease back to 2%. So you kind of have two scenarios. You have a high inflation scenario and you have a low growth scenario under that maximum tariff implementation potential. With that being said, our base case right now at Kpler is that it's going to kind of be a mixed approach. We think that Mexico and Canada will come to a relatively quick agreement with the United States. And tariffs, if they do come into effect for any period of time, will not be for very long at all. They will find a way to negotiate through it. Whereas for China, we think that tariffs will be in place for an extended period of time and are likely to build on the 10% we currently see right now. So under this kind of mixed scenario, we go back to my expectations I announced at the outset of this presentation, and that is US growth, again, above trend, 2.5%, but inflation sticky in this range between 3.5%. And again, that sticky inflation thesis, as a result, again, of tariff policy, of a tightening labor market, and relatively elevated US growth levels. So again, that's kind of our tariff scenario right now. This might need to be altered in the coming months, depending on what comes out of the White House, but that's kind of what we're assuming right now. Shifting to China next, again, kind of coming with that economic narrative. If the United States was outperformance, China would be one of imbalance right now. China faces serious structural economic issues of overinvestment and underconsumption. And if you look at the chart on the right, I've kind of listed investment and consumption as a percent of GDP. Consumption is roughly 40% of GDP, investments roughly 41% of GDP. Long-term sustainable growth in any economy requires investment at a rate closer to 20 to 25% of GDP, consumption in a range between 60 to 70% of GDP. This conversion from an investment to consumption-led growth model is typically very painful. We've seen this historically with a number of countries, and it either typically requires a very deep economic downturn or some type of long-term stagnation. Our view for the long term when it comes to China is one of stagnation. Something that looks very similar to Japan. And as a result, we're assuming over the long run that China likely stagnates with growth below 2% through the 2030s. However, in the short run, you have to take the view of, if China decides they want to implement aggressive stimulus, you could see a bit of a rebound. And so, the thing I've been communicating to clients is I'm not that positive on a short-term rebound for China unless we get something in the range of 100 to 200 billion in fiscal stimulus committed to stimulating consumption and stimulating household demand. Again, I think it's going to be really hard in the long run, given these structural issues, to forego or prevent some type of stagnation in China. But again, I think in the short run, if we do get some kind of aggressive stimulus, I'll feel a little bit more positive about a short-term rebound in China. And kind of as we dig into that a little bit, just talking about stimulus policy so far, we saw the Chinese government in September start to announce very aggressive stimulus measures, and those have kind of flowed through into the new year. However, most of this stimulus has been monetary in nature. And so that's cutting interest rates, that's providing more liquidity to the market. And most of this flows through to higher amounts of investment. Yes, it stimulates a little bit of consumption, but mostly by cutting rates, you are stimulating investment and just exacerbating the imbalance problem apparent within China. And you can even see this in the general public budget, which is China's official spending budget. Yeah, they have some off-budget spending measures, but if we just look at the official measure, against planned spending growth last year, they didn't even meet planned spending growth, right? So fiscal expenditures on their official budget, growth actually came in, spending growth came in above where they had expected it to be, right? So they were not very aggressive on the fiscal side. And again, as I mentioned, I'm kind of looking for if the Chinese government and Chinese policymakers are willing to more aggressively fiscally stimulate this year, but we really haven't seen it. And of course, if you look at the investment side of the Chinese economy, just focusing in on the left-hand side chart, that blue line is year-over-year industrial production growth. And we saw that production growth level bottom out in August at 4.5%. And lo and behold, in September, China stepped in with aggressive monetary measures. And we've seen industrial production growth push right back to 6.2% towards the upper end of the range. Even looking at PMIs on the right-hand chart, pushed back into expansionary territory for a period of time through the end of last year, right? So this monetary stimulus really helping investment. We think that this is likely going to continue through Q1. And then you're going to start to see weakness in the investment sector again, say maybe industrial production back at levels between 3.5% and 4.5% by the middle of this year. So you might ask me, what's the question with investment-led growth? The problem with investment-led growth is you start to get to a stage where you are far out producing your domestic consumption base. And this requires ever larger current account surpluses or larger trade surpluses. So focusing in on the chart to the right, this is just your yearly Chinese trade surplus. In December alone, the Chinese trade surplus was 100 billion, more than double levels from 2019. Again, if you look at the chart on the left, most of this is being driven by a surge in exports post-COVID, right? And again, this is being driven by excess production relative to China's domestic consumer base. And this is a lot of the reason why you're seeing countries like the United States really start to get aggressive with tariff policy. But this isn't just a US story, right? Canada, Mexico, Europe, Brazil, India, these are all countries that are looking to implement import tariffs of their own because of this trade imbalance problem. And so it is our view that this model of growth is going to increasingly come under strain over the next few years and even just over the next several months as the United States, which is the behemoth in the room at 25% of global consumption, really starts to take on this issue through tariff policy. And I like to use steel production as a good case study. If you focus in on the chart on the left here, we've seen an absolute cratering in construction starts over the last couple of years. And yet, if you look at crude steel production, it's held up at relatively consistent levels. And what has that resulted in? Excess supply, which China's been forced to export abroad. We've seen a huge surge in steel product exports out of China over the last couple of years. This helps to explain why places like Brazil have implemented 25% import tariffs on Chinese steel. They're trying to protect their own domestic industries. Even places like India, which have a large need for steel, have implemented limited import tariffs as well. Right. So this is kind of a good case study of what's happening across a lot of products that China is exporting right now. And of course, if you look at the Chinese consumer, it looks weak, right? If you look at Chinese consumption against pre-pandemic trend, we're solid 10% below trend right now. And of course, this is resulting in a deflationary environment or near deflationary environment. Why? China's outproducing their domestic consumer base. We have a lot of stuff and not a lot of demand. That results in a pretty deflationary environment, right? So this kind of helps to explain why this Chinese growth model is coming under stress and why they need to start to find ways to move to a consumption-led model of growth, because this investment to manufacturing and investment-led model is really going to come under stress with rising tariff barriers very much in place. Let's go ahead and shift to the European Union next, kind of our third major economic bloc. And again, if we're talking economic narratives, again, for the US, it's outperformance. For China, it's imbalance. For the European Union, it is malaise. Europe is very much in a malaise at the moment. And look, this GDP growth chart on the right here is a perfect example of that. Growth flatlined in 2023. We got a little bit of an uplift through 2024, and yet Q4 really disappointed again, and any momentum we thought we had just ended through the end of last year. It's been tough, right? Nonetheless, European inflation levels have been exceedingly sticky. My expectation coming in last year was that we would see core inflation back at 2% because of the economic environment in Europe. We just didn't get it. So inflation's been relatively sticky. And this has put the ECB in a difficult position, right? They did start the cutting cycle in June, but it's been a relatively slow cutting cycle. Say they've cut 125 basis points since June. That's much slower than, say, the 200 basis points of rate hikes they implemented in 2023 alone, right? They're also still well above the neutral rate, which we estimate is around 1.75 to 2%. Current deposit rate is well above that right now. And so, again, despite a relatively middling European economy, sticky inflation has put the ECB in a difficult position. And if uh, just focusing on kind of expectations for this year, and just thinking about where we think things are going, we do think that things will pick up in Europe. We're expecting a 1%, 1.2% rate of growth, up from 0.8% last year. Much of this is being predicated on the hopes that we get improving household consumption. However, I will say that I think there are distinct downside risks to our GDP forecast at this moment. And I'll kind of explain why. So if you look at consumer confidence, that left-hand side chart, we've seen a big recovery post-COVID, and it peaked post-Ukraine war, It peaked in October of last year. And through Q3, things were starting to look pretty good, right? If you look at monthly retail sales in inflation adjusted terms, we got a big uptick through Q3. At that point was when we were starting to form our expectations for European growth. And we, those of us on the economics team were starting to feel more positive, say, okay, finally the European consumer is returning to the fore. And then Q4 hit. We saw consumer confidence erode again, and purchases flatlined, right? Disappointing. So right now, I would say that we are still, calling for an uptick in growth in the euro area to 1.2%, built on this improvement in household consumption. But again, we admit there's some considerable risks, especially after the lack of showing through Q4. Of course, look, European consumers have plenty of dry powder if they want to go out and spend. It is there, right? If you look at household deposits, things look healthy, right? Deposit growth was, picked up in 2024. Things looked good. Unemployment at a generational low in the European Union, right? So it's not that people don't have the money to spend. It's just they're not going out and doing so, especially in Q4. So again, that's kind of the important thing to understand right now when it comes to kind of predicting European growth levels. And of course, focusing on the inflation piece, as I mentioned, going back to my favored view of inflation, core inflation, smoothed over a 6-month moving average basis, that chart on the left, late 2023, things were looking like we're getting back to 2% pretty soon here. And then things got sticky. Inflation pushed back to levels above 3%. This really pushed the ECB into a tough position. And again, this was against our expectations, certainly. We were thinking inflation would get back to 2% last year. We just didn't see it. And this has really caused the ECB to have to take a very slow and steady approach to rate cuts, which you can see in the chart to the right. However, we do see inflation getting back to 2% this year, again, because the European economy continues to be pretty middling. Yes, we do see an uptick in growth to 1.2%. That's still below long-run trend. We do think, again, inflation's back at 2% this year. We think that the ECB also will probably get rates back to a range between 1.75 and 2%, right in line with neutral, right? So maybe another 3 to 4 cuts by the end of this year. And just shifting, one last comment on the investment side of the European economy. Look, it's struggling, right? Specifically around the manufacturing side of the economy, it looks weak. There's not much sign of an uptick yet. I think hopes of any kind of uptick in manufacturing likely not until the second half of this year at the earliest. However, we did get some improvement in construction activity through the end of last year. If you look at the chart to the right, we did see some positive growth levels. Let's see if this can kind of provide an offset to continued weakness across the manufacturing sector. There's also questions, just going back to this rate chart, around rate policy and how that translates to long duration rates. We have seen a surge in long duration bond yields in Europe. That is problematic for investment. Yes, they've come off a bit, but they still are towards the high end of the range, going back 12 months in time. And so we would like to see more downward movement in long duration rates to kind of help the investment side of the European economy, which is already under real strain right now. Shifting to just a couple of additional economies here in India and Japan, and then we'll take some questions. So again, going back to my economic narratives, if the U.S. is outperformance, China's in balance, Europe is malaise, uh, India would be cracks emerging. India would be cracks emerging. Um, the big problem with India right now is GDP growth underperformance, right? Coming into last year, I had predicted a plus 7% growth rate for India, with the likelihood of that continuing possibly through the end of this decade. A lot of folks in the market were hoping and predicting the same thing, and yet it's looking like this is really not going to play out. Even growth for 2024 is looking like it's going to come in at, say, 6.5%, so well below that 7% level. If you look at GDP growth year over year, that Q3 figure, which is the latest data we have, was at 5.4%, again, well below that 7% level that many were hoping for. It's important to keep in mind when we're talking about Indian growth, it's all relative to expectations. Yes, a 6.5% growth level is still really high relative to what a lot of us in the West are used to. But again, relative to expectations, even from the Indian government, things are weaker than have weakened more quickly than we had expected. And so that's kind of the core thesis right now when it comes to India, is kind of cracks emerging. We see growth kind of holding at this 6.5% level through this year. If we talk about just kind of what was that core driver, of course, India is a consumption-led economy, but investment has been a pretty key driver of growth over the last couple of years. If you look at 2023, I mean, year-over-year growth was, topping out at 8, 9, 10%, right? Really high. But again, Q3 of 2024, we saw investment growth really start to show signs of flowing back to, just above 5%, right? And again, this is definitely coming in, slowing at a pace that folks were not expecting at this point, right? We were expecting investment to kind of hold up for a longer period of time. Even looking at industrial production on a monthly basis, again, especially beginning in August of last year, growth rates started to structurally narrow relative to what we've seen the last couple of years. Unfortunately, the RBI does not have a lot of flexibility to cut interest rates right now. We did get a cut, first cut in 5 years, amazingly, last week. However, the RBI continues to face kind of two headwinds here. One is persistent inflationary issues, especially food inflation, and the RBI takes into account food inflation when they're setting rate policy, and a weakening INR, right, or weakening rupee. And so both of these are kind of limiting how much the RBI can do. Of course, the central government has implemented tax cuts to try and incentivize more investment and consumption. But at least on the monetary policy side of things, I don't think we get more than another 50 basis points of cuts through the course of this year. So not a very aggressive rate cutting policy here. Lastly, just to finish it out, we're going to take a look at Japan. And I think, again, narratives: U.S. outperformance, China imbalance, Europe malaise, India cracks emerging. I would see for Japan, it would be inflation is back again. Inflation is back again. And that is the major problem for the Japanese economy right now, is a reinflationary impulse. I'll come back to this chart in a moment, but if we just look at inflation in Europe right now, in Japan, we have certainly seen a reacceleration off levels that were below target early last year. This has basically pushed the Bank of Japan to steadily hike rates. And look, they're hiking rates into an economy that doesn't look great, doesn't look terrible, but it's just very mixed, right? If you look at the chart on the right, Japanese growth was up the last couple of quarters, but it was kind of up and down before that, right? So it's kind of a mixed environment economically in Japan. But again, inflation's become a problem, largely driven by a lot of wage inflation. And so this is kind of pushing the BOJ to have to hike rates, alongside a lot of yen weakness too over the last couple of years. And so kind of a tough economic situation for Japan right now. I think for those of us in the West who are maybe thinking about how, Japan relates to the global macro picture, keep in mind that you have a lot of folks who are borrowing yen, converting it to another currency, and then deploying that into assets with much higher yields than, say, what you could get in Japan. The risk is that as the Bank of Japan raises rates, you start to see a removal of that liquidity. Less folks are looking to borrow yen because of higher interest rates in Japan. You also see some of that yen carry trade being unwound. There is a risk that that unwinding can create periods of high volatility. We saw this in early August when the Bank of Japan unexpectedly raised rates, and then we got a relatively weak US jobs report the day after. This caused an absolute surge in volatility. The VIX surged to a multi-year high. There is a risk that this could happen again if the Bank of Japan is not careful in making sure to announce future rate policy, right? So again, for those of us who may be sitting in the United States or Europe or elsewhere, I think when we're thinking about the Japanese economy in terms of how it might affect global macro, it's really risks around injecting volatility into the market. All right. With that being said, that's all I've got. I'm going to hand it off to Matt, and I think he's going to look at some questions.
Yep, sure. Thank you, Reid. That was very comprehensive, excellent as always. We'll just give you a brief pause to catch your breath, have a quick sip of tea there. So, but no, that's great. So, everybody, if you look down the bottom of your screen there is a Q&A button. We're starting to get a couple of questions in, but please throw them in there. While we wait for those questions to come in, I'll just throw you one, Reid, first of all. And to be candid, Reid said before we went live, he was like, ask me anything. So I will do. You were talking about US inflation, Reid, and how sticky it's been in terms of it being driven by shelter. But then you were talking about the stickiness in inflation in Europe, which was kind of surprising. What's kind of been the driver of that? Has that been energy costs, and do you expect that to continue?
Surprisingly, it's also been services inflation in Europe. We saw through the middle of last year, services was topping out above 4%. A lot of this was issue with rents and housing expenses, just like in the United States, interestingly enough. Albeit a large driver of that has been just the lack of construction growth in Europe. However, thankfully, services inflation in Europe has come off. It's kind of helped to drive that core inflation lower over the last 6 months. And it's also encouraging that we've seen construction activity in Europe really pick up over the last 3 months of this year, which could help with this services inflation issue further, particularly when it comes to rents and buying homes.
Very good. I knew I couldn't stump you. Okay, so we've got some questions come in here. First one, it appears that the Trump administration considers tariffs to be a source of financing for tax cuts. Do you agree with this assessment?
Yes, most definitely. I think they do. They are likely overestimating how much they can receive from tariff implementation, especially if you have aggressive reciprocal tariffs or trade diversions over time. But I certainly think that the Trump administration and congressional Republicans and Democrats view it as a way to drive some revenue into the US Treasury. I think it is important to keep in mind when you're thinking about tariff implementation, we do also need to consider what happens with the US dollar. If the US dollar appreciates a lot in the face of tariffs, that would imply a pretty elevated amount of revenue into the US Treasury because it's kind of keeping import prices relatively consistent on a forex weighted basis. So something to keep in mind there. If the dollar doesn't appreciate as much, you could see trade come under more pressure. You could see a bit more manufacturing reshoring, and revenues could be a little bit lower. So it's important to kind of think about that trade-off when it comes to tariffs.
Which dovetails perfectly into our next question, which is how do you see the US dollar performing versus other global currencies? So I guess particularly against like the euro for this year. And then just yeah, just answer that piece. You've already answered the second piece of it.
Yeah, I think right now you have to be structurally long dollar. especially if we do see more aggressive tariff implementation. We saw that last week. Tariffs were potentially coming on, and the dollar was strengthening against the euro, strengthening against the loonie, strengthening against the Mexican peso. Right. I think right now, even if you remove the tariff conversation from the picture, the U.S. economy is just outperforming most other major economic blocks, and you have U.S. Long duration yields rising, right? So I think that that's an environment. The ECB, for example, is cutting while the Fed is likely pausing, right? So I think that that is ultimately an equation for dollar strength. We do have a call that Euro USD touches parity at some point this year. So again, long dollar makes sense for right now.
Okay, next one. So with that in mind, I guess then what about the US economy? What is the risk to the US falling into a recession, and what could prompt that?
So, people like to ask this question. I understand why. I think it's really important to understand that the US doesn't go into recession without something breaking, right? A financial crisis, COVID, right? So right now, I would say the probability of a recession in the US is say maybe 20% on the back of some kind of deep policy error out of the Trump administration that causes something to break in the US economy. But again, I think that chance is relatively limited, 1 in 5, as of this point.
Okay, very, very US centric questions here. So the next one is, with President Trump pushing to cut the interest rate, how does a weaker US dollar influence the effectiveness of tariffs? So I guess the question is, do you think he'll be able to actually push through interest rate cuts as well?
I don't think so. I think that the Fed's going to kind of stick through and look to, basically take on, focus on their inflation mandate, focus on their full employment mandate. It was interesting. The Trump administration mentioned that they would like to see long duration rates decline. That is certainly the view you want to take if you want to try and stimulate U.S. growth, but that could be difficult just given the current uh, macro policy and deficit environment we're in. I think in terms of thinking about trying to correct a very, negative U.S. current account deficit, the Trump administration, I think in the long run, would like to see a weaker U.S. dollar. In the short run, a strong dollar helps with tariff policy. But I think in the long run, a weaker dollar actually it makes U.S. exports more competitive. It makes U.S. manufacturing more competitive.
Mhm.
And this is kind of similar to what we saw in the Reagan years in the 80s when we saw this concerted effort to try and weaken the dollar. I think this time around that's a lot harder to pull off because the Chinese are not necessarily willing to play ball. Um, but it's going to kind of
Gotcha.
be interesting to see, do we have some kind of currency accord in 3 or 4 years? I think for now, though, the Trump administration is going to try and use tariffs to do some of that job.
Okay, thank you. Okay, Eurocentric question. Does the ECB have room to cut even though inflation seems sticky?
Yes, I think they do right now. Kind of as I mentioned before, I think we see rates at a range between the deposit rate at somewhere between 1.75 and 2%. It's going to be a very cautious cutting cycle, though, um, which is not where the ECB would likely want to be at this moment. They would probably like to have rates back at neutral right now, given where the European economy is. But I think that you'll see a very cautious approach. Say maybe every 2 or 3 meetings you get a cut, and they're always going to, policymakers are going to say, we're watching inflation data, we're data dependent. So if inflation, shows signs of getting sticky again this year, really doesn't keep moving towards 2% like we've seen the last 6 months, you can probably expect a pause out of the ECB. They're in a tough position, right? You have the
Mhm.
US economy growing above trend, and the Fed kind of paused, and then the ECB is trying to cut into that. That's difficult, right? And puts pressure on the euro as well. But I think they're going to try and slowly get rates back to that neutral level by the end of this year.
Cool. All right, last one, and then we'll let you go. Okay, so do you believe that Chinese tariffs leave the door open to a negotiation with the Trump administration?
I think they do. It was kind of interesting. Uh, you know, One, Trump only implemented a 10% tariff, which was pretty limited. And then the Chinese came out and implemented their own tariffs on only like 13 billion of US imports. So, I think Xi is clearly leaving the door open. I think Trump would like to get a negotiation done. I think it's going to be very hard for them to come to an agreement, though, given what Trump wants to get done. But I think that for now, both leaders are trying to leave the door open. We'll see what happens.
Okay. Awesome. Well, thank you very much, Reid. Thank you, everybody, for joining. I've had a great 45 minutes here. We'll be sending this recording out later to you all. If you have any other questions, you can follow up with Reid or send an email to research@kpler.com. Have a great rest of your day, and thanks again. Bye-bye now.